Hello and welcome everyone to another market update. Today is Wednesday the 12th of March. There is a lot going on and you may have been noticing a bit of volatility in markets, which I'm going to talk about today. Top three things today are going to be quad 4, which is actually to say a quad 1 to quad 4 shift. Number 2 is volatility. Number 3 is going to be inflation. The first big thing that's happened in the last couple of weeks is that instead of getting a quad 1 or 2 in the month of March, as we had originally, or I had originally been suggesting would occur, and that was based on the economic data and what was going on in both economic data and inflation outlook, it would appear as though we have had a slowing. Actually, it wouldn't appear as though we have had a slowing. So let's talk about real things, real numbers. We have had a slowing in a few key economic data points in the United States. This is suggesting that we are going to experience a quad 4 in the month of March. The market is experiencing a quad 4. And that is, if you look at broadly what's been going on in markets, we've seen a sell-off in all the big Mag 7 names, so big tech, all selling off massively. So that's your Nvidia, Tesla, Microsoft, Apple, Google, Facebook, who have I missed? Netflix, all the big Mag 7 names, those huge momentum stocks, all sold off, all getting hit hard. The biggie though is crypto. Crypto gets absolutely eviscerated in a quad 4, and Bitcoin has been eviscerated in the last couple of weeks. It's gone from around 100,000, give or take a few dollars. I'm putting up a chart of Bitcoin here on the screen. So back in Jan, Feb, we were sitting around that probably $100,000 to $105,000 range. We're at 82,000 USD for a Bitcoin. That is an absolute shellacking of the cryptos, and all the other related crypto stuff would have also been hammered at the same time. Buying opportunity, not sure yet. Probably over the long term, yes. Is it safe to go back in the water at the moment? Probably not just yet. Going to see a few more data points, I think, before we decide to reallocate to big tech and some of those other crypto assets. One of the things that, and I'm going to get to inflation and a few other things in a moment, but one of the things that's interesting is the mainstream media is making a big deal out of this tariff stuff. Now, I don't know if you've been following any mainstream financial media in relation to the tariffs, but it seems like, one day Trump says there's going to be this % tariff, and then within a few days he says, well, okay, we're not going to do that. And the market, of course, is trying to digest and deal with all of this, and it's happening so thick and fast that, of course, the market is trying to figure out what all of it means. I think that the tariff stuff is really just a narrative and a bit of a sideshow, and I've probably said this before, but I don't know that the end game really is for all these tariffs to be put on other countries' goods coming into the United States. Typically in history, what happens with tariffs is that it starts sort of a trade war. And sometimes trade wars then develop into like live shooting wars. Now, we certainly don't want to go down that path, and I don't think Donald Trump is doing the tariff thing to try to start a shooting war with someone. He doesn't seem to be the type of person, let alone president, that's going to get the U.S. embroiled in more military-style engagements. In fact, when he was in his first term, he didn't start any new wars, and in fact, I think he tried to avoid conflict at all costs. And I think he's more of the art of the deal kind of guy, right? He's using, I think, my sense of it is, and in a year's time we'll look back on this and know for sure what was the point of all of it. But my sense of it is he's trying to gain some sort of leverage or a readjustment in trade terms with some of these other countries. And I think my broad feeling on trade with the United States is that for a very long time the U.S. has made trade terms or allowed trade to be more favorable for other countries. And that's probably one of the reasons why there's such a large deficit. There's been a lot of trade deficits for a long time, etc. So anyway, that could be one of the reasons why we're seeing a bit of uncertainty, in particular in the personal consumption space, which we saw the PCE, which is personal consumption expenditure numbers, decline in the last month, and that's a sign the consumer is probably a bit concerned about what's going on, particularly around tariffs. It's also a sign, though, that the consumer isn't out of the woods yet. Cost of living continues to be a problem. That's both in the U.S., in Australia, and obviously other parts of the world as well. We also saw some manufacturing data decline, surprisingly. So the market has now discounted for a quad 4 in the month of March, and that's what we are defending against at the moment. So I have reallocated some capital to more defensive bond positions and things like that, and maintained a little bit more cash. We're still wearing the effects of a lot of this market volatility. And just on that point, with point number 2, market volatility has spiked hugely. And by hugely, I mean the last update that I gave would have been probably about 12 to 14 days ago, something like that. So probably late Feb, very early March. And vol was sitting around the high end of the investable bucket, but not the end of the world. It was sort of around the somewhere in the 14, 15, kind of up to about the 18, 19, 20, but not looking like it was necessarily going to spike higher. Well, it spiked higher. And we've got some big events coming up that the market's pricing in volatility for. The first thing is we have an inflation report coming out tomorrow. Now, the interesting thing about inflation, actually I'll get to inflation in a moment, but suffice to say, the volatility indices, the big ones that we look at, that I look at, the VIX, which is the S&P 500, the NASDAQ volatility, and the Russell volatility are all now borderline in the F bucket, which is the uninvestable bucket. The VIX volatility has just bounced, has just gone up to a sort of a new high, cycle high, and has come back from that. And it will be interesting to see whether volatility now starts to come out of the market. Oftentimes, volatility is driven higher around events, so event risk. Something like a big earnings report from a big tech company like a Google or a Microsoft or an NVIDIA will drive short-term market volatility. And then once the event occurs and the report comes out and the market deals with it, the volatility comes out of the market. We have one of those volatility style events coming up, which is the inflation report. So just moving on then to the inflation report, I do have a chart I want to show you of the projected inflation. So inflation had been rising up until January. It did come down in Feb, and it's going to likely ratchet lower again in March. Now, this is good news for us as consumers and investors, because it's going to give the Fed now the cover to consider and to probably act on that data and to lower interest rates. So they'll be able to potentially do another 25 or who knows, maybe 50 basis point cut, but probably 25 at some point, maybe in March. We'll see. And what that's going to do, of course, is if the Fed signals that it's getting happier with the inflation outlook and where inflation is going, then that will give the market, I think, a bit of a tailwind. And we'll see that this monthly, in March anyway, quad 4 could very easily then become a quad 1 or 2 in April. So that's the inflation outlook. Inflation is going to begin decreasing. That's in the U.S. Now, we'll have to see what happens in Australia because, again, due to our currency fluctuations, we often import our inflation. Oil prices have been coming down pretty substantially. However, the price at the pump seems to vary a lot, I've noticed. I think when I was driving around town yesterday, I noticed fuel level, unleaded level was around $1.85, $1.90, something like that, where it's been as low as about $1.60 to $1.70, somewhere in that range. But the price of a barrel of oil is around $67 US a barrel, which is down quite substantially I think from a high of around 70, 75 over the past couple of months, and even a smidge higher. So we're seeing now commodity deflation as opposed to commodity inflation, and that's playing out in these inflation numbers here, where we're seeing the inflation having rolled over and now declining. So that's a good thing. That is a good thing. Let's talk though the next couple of months of quads. So this 1 has become a 4 for the month of March. We have a quad 1 slated for April. Now the probability of that happening is quite high, but I think given the circumstances of high volatility, some economic data that's a bit iffy at the moment, we're just going to have to wait and see what plays out. The interesting thing, and I wanted to show you, I think it might be here, I can just grab it anyway. The interesting thing to note about the difference between quad 1 and quad 4, and you'll notice on the left side, on the left side of this 4-quadrant model, quad 1 and quad 4 are in the same half of this chart, and quad 2 and 3 are in the same half of the chart. The reason they're in the same half, 1 and 4, is due to inflation. So the inflation metric here is on the x-axis, right, which is this axis here, left to right. And so inflation is decelerating in quads 1 and in quad 4. We have a deceleration of inflation, and that's what's happening. The interesting thing that we've got going on right now is we have growth is decelerating as opposed to growth accelerating in quad 1. So what we want to see happening is for the month of April, we'll want to see growth resuming or accelerating. The other thing, of course, we'll likely see is the Fed continuing to be a bit more dovish, and again, that's sort of a quad 4 metric. So the interest rate complex, which I do talk a lot about, is discounting rate cuts. What that means is that it's pricing in lower interest rates through the course of this year. So again, that's a dovish, or when you look at the monetary policy side of things, that is a deceleration of interest rates. Again, that's a quad 4 characteristic. Now you can still have a dovish Fed or interest rate policy that's neutral, as suggested here in the quad 1 description. Just looking for the word description here, and that you can still have a quad 1 where the Fed is cutting rates. But the key metric I think for quad 1 is that we need to see growth accelerating, and right now there's a bit of a question mark on that. Having said that, it's not really easy to see on this chart here. I don't know that I've got it anywhere else. I was hoping to maybe, well, anyway, I won't worry about it. Let's go to the playbook. What I was going to say is that I was going to look out to the next couple of quarters, and maybe this table tells me now it doesn't really either. We should see growth reaccelerating through this part of the year. And again, towards the middle and back half of this year, we have accelerations in growth likely, and that's noted by the quad 2 environment that we're higher degree of likelihood that we're going to find ourselves in. Okay, so let's talk playbook for just 1 second. As you can see over here on the quad 4 playbook where we are at the moment, we want to be holding things like fixed income, gold, and dollars. And the worst sort of equity sectors to be in, because I've talked about this a lot, right? If we look at quad 1, 2, and 3, the one common theme across 1, 2, and 3 is tech. Where are you? Tech. Here we go. Best equity sectors. Tech, and tech is in there. And certainly for quad 1 and 2, tech is the bee's knees. That's where you want to be. There are others as well, but tech is where you get a lot of bang for your buck. Commensurately in quad 4, tech is one of the worst. Now the good news about, I suppose, a quad 4 is it typically doesn't last very long. We do have quad 4 scenarios and have had quad 4 scenarios where you can get several quarters in a row, and usually that's where a recessionary environment is likely, or something like the pandemic that occurred. Some shock event that causes a huge ripple effect through the economy. We're not in that sort of scenario right here. So what I'm saying is that whilst we do have a quad 4 month, or well, we've had 2 months in a row of quad 4, and that does require a repositioning of portfolio or just some changes to be made, we're going to come out of that, or well, we should. The probability of us coming out of that in the next couple of months is quite high. What are some of the risk factors, though? Well, some of the risk factors could be if something really bizarre happens with the tariffs and Trump, or perhaps Ukraine, or something else that might cause some real defensiveness or concern to be put into the market. Right now, I think the market is just going through a normal correction around the data that we've got, which is suggesting a bit of a slowdown. Now, once the inflation data gets reported, it's going to be interesting to see what happens tomorrow in tomorrow's trading session. So Thursday our time, Wednesday US time, when this data gets reported, how the market reacts. And then when we get a Fed meeting or commentary around that, again, the market will start to price in whatever the Fed is saying or discussing about inflation. So that's a pretty key data point. And again, that's why volatility's probably spiked a little bit here, is because market traders and so forth are trying to price that in. There's some other things going on under the surface in the market which has exacerbated this sell-off. I'm not going to go into those details. It's a little bit technical, but it has to do with volatility control funds, which basically trade systematic volatility strategies. And just high level, what happens with those funds, and there's billions of dollars in these funds, what happens with them is once the market goes to a certain place, like it's got a lot of volatility, if there is that, the volatility perpetuates itself. And so moves beget moves. What I mean by that is, as a sell-off starts to happen, it gets worse because the volatility control funds have to sell into that. And also what happens on the flip side of that is when we are in a low vol environment and we're in a rally, the volatility control funds have to buy into that. So we're in that part of the mini cycle, if you want to call it that, for lack of a better phrase, where the volatility of the market perpetuates selling. And at some point, this is going to present a great buying opportunity, which I'll take advantage of. But I'm just sitting on my hands kind of in the moment, again, being a bit more defensive with investments. And once we get out of this quad 4 regime in the playbook, it means we can allocate capital back to riskier assets or risk-on type assets like your tech and some of the other market segments that we've been exposed to. So just to wrap this up, because I know some of you look at markets every day and you might be feeling a bit of consternation or wondering what's going on. Hopefully, and rewind and re-listen to this update, but hopefully you can understand that the big drivers right now of this market correction are volatility, the upcoming and impending inflation data report, and to probably a lesser degree some of the newsy stuff going on that people, retail investors, trade on, like the tariff news and all this kind of stuff. It is whipping the market around a little bit here. Long term, though, I am still very comfortable with the quad outlook for the rest of the year, with one caveat, and that is to say, and I've said it before, I'll say it again, we remain data dependent, and that is where when data comes through that says something needs to change or be changed, that is what typically is actioned by my good self on markets. So I hope all that makes sense. If it doesn't make sense, feel free to book yourself in to my calendar. Use the book meeting link at the bottom of my email footer, or hopefully something will come through in this update where you can do that. You can call the team as well. Call a number to book yourself in. Easiest thing to do, though, is just get that book a meeting link and Just book yourself into the calendar. The key thing, though, is don't panic, don't stress, and don't fret or worry, because these sorts of small corrections do occur from time to time. And what I am endeavoring to get better at is timing those so that we can protect capital and then compound it even more by taking advantage of buying opportunities and such like. So with that, I'm going to say have a fantastic rest of the week. I hope for any of my Queensland clients that you are safe and that you didn't have too much any issues at all around the cyclone, other than maybe a bit of rain and some high winds. Hopefully no flooding or other damaging issues for your homes and your families there. And with that, have a fantastic rest of the week. I'll leave another market update probably early next week after we get the inflation data and we see what the reaction is from the Fed. And there's probably going to be more to say on Monday or Tuesday of next week on that. All right, take care. Talk soon. Bye-bye.